Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. It has been interesting as always, and I got to tell you, I think today's show we're going to talk about a lot of the changes that have been going on in the economy, why it's truly different this time. Actually, it's different every time. I mean, certain things have a tendency to repeat, but not in any order that would allow you to predict it with a high degree of accuracy. So, you know, if you keep doing certain things long enough, eventually something happens, good or bad. And there's an awful lot of stuff that's really good. I mean, it's mind-boggling. I know a lot of people are upset by the headlines. And you have to remember that being people, okay, we have a tendency to pay attention to bad things that happen more so than the good things. And the people that own news channels, they know that. So they're going to put a lot of, I don't know, I think back, well, this is going way back. There was an old saying in some of the journalism classes, if it bleeds, it leads. They were, you can probably figure that out on your own. I don't even want to spend any time explaining that. But I got to tell you, the more I'm reading, the more I'm seeing. It is mind-boggling how fast technology is progressing. Although it's not fast enough for me. I'm like everybody else. I want to be going all halfway around the world in an hour, the way that Elon Musk is and all these guys are racing. That, by the way, that's why they're racing to be in outer space. And you'll notice that they're not going to another planet. They're just going up and coming back down. They're doing the test flights so that you can, if you've got a lot of money, you'll be able to go up and get on one of their rockets. You'll pay them a bunch of money, but you'll be halfway around the world in about an hour. I mean, think about that for a second. About an hour. It's mind-boggling. I feel like I'm back in 1996 when I was explaining to people what a smartphone was or a smart device. It hadn't been invented yet, so wasn't even calling it that. We're talking about phones where you could actually send and receive video. And in 1996, I'm telling you, people went, oh, yeah, right. Yeah, like that's never going to happen. And so people today that were born in 1996 are pretty old, actually, so they don't remember any of that. And it's not super old, but old enough to understand or maybe find some humor in that people didn't think that this was going to happen. So kind of cool. I mean, it's, when like I said, when they say it's different this time, and I got to wonder why Russia backed down. That's kind of unlike them. And I was talking to somebody who basically has got friends, different places, and he was saying, oh yeah, the Ukrainians, they're not even worried about this. All this stuff is done in U.S. media. And I was going, wow, could that really be true? I don't know if it's true or not. I think it was just repeating a rumor. But anyway, the bottom line is you've got the largest economy in the world, And China's catching up. China has problems, by the way. We all have problems. Everybody has problems. But the good outweighs the bad in most cases. They're a fierce competitor, which I don't mind. It keeps you sharp. If you want to get better, you know what you do? You find out who the best person is in the field that you want to participate in, and then you challenge them. It's the same way with sports. If you want to get better at basketball, then you should probably try to play against players who are better than you. That's how you get better. You compete. And competition brings out the best in everybody. A lot of people don't like to compete, and I get it. I understand, because you're going to put everything you got line, and that's what we do. That's what the people in this country do. And these kids today, they're sharper. I mean, they're more in tune with technology, which they're going to need big time if we're going to keep up. And it's happening. I mean, I'm amazed at what we're seeing. I'm really amazed. I didn't think this stuff was going to start coming out for another 10, maybe 15 years. And it looks like a lot of the stuff that I thought might have been happening down the road is happening a little quicker. So, and then that's a good thing. It makes most of our lives easier. There are a lot of challenges involved. You're going to have a lot more education. High schools are going to have to be completely redesigned at some point in time, because you can't come out of high school today prepared for a job. You can't come out of high school prepared to contribute to the economy. You have to do further schooling. So we've got that to work on, and that's actually a good thing. It'll evolve. You're going to have to hire people in there. You're going to have to get experts in, and you'll have to have people coming in and teaching kids how to be electricians. I mean, how to work on electric cars in high school. My mind is going on me. Don't get old, people. I had a class, and it was auto shop, and it was in high school, and I think I was a senior. And fortunately, I had a 1973 Dodge Hornet that needed a whole lot of work all the time. So we got to work on my car all the time. It saved me a lot of money. It actually helped out the teacher, because he was explaining all the stuff that we were doing to my car, and all I had to do was buy the parts. So that was kind of cool. I don't think you'll ever see that again. You open up a hood today on an electric car, you touch the wrong wire, and that's the last wire you're ever going to touch. So it'll be a little more dangerous. Although some kid did cut himself really bad on a saw once, wood shop. But beyond, now I'm just rambling. But it's interesting to see how far that we've come and where we're going. The direction could change, and the directions change all the time. But I really like what I'm seeing. My biggest question is, where are we going to get all the people who have the skills necessary to implement and manage and maintain all of this new equipment? That's a problem. And if you're able to get trained in those areas, like I said, electricians, linemen, electricians, they can work on just about anything. You've got all this machinery that's coming out. And I kept meaning, I really want to go back and do some research. Maybe I can get somebody from Lincoln Electric to come on the show one day. They have a school that you can go to. And the last time I looked, and it's been a couple of years now, actually it's been probably 4 or 5 years. Last time I looked, the program was a little over a year of schooling. You couldn't take it all in a little over a year, but so within about 2 years, you could go to school there. And when you graduated, they started you with the very basics and moved you all the way up to fixing the robotic welding equipment and managing that and maintaining it. And those jobs are really good jobs. And the cost of their school was about less than half of the cost of a normal college degree. And when you made it all the way through there, you got to pick from different jobs that you might want to take. So it's out there. Now, I sat next to, right around that same time, it was kind of interesting. I'm sitting on a plane, and I'm talking to a lady who represented the U.S. Auto industry, the dealerships. And she was had an awful lot of information on the programs that they had for master mechanics at auto dealerships. And this was a while ago. I mean, she was saying these kids come in, if they qualify, they train them and they pay them while they're being trained, and they pay them a nice livable wage. I mean, really good livable wage, especially for an 18-year-old. And then once they finished the school, and it was about 3 to 4 years, those kids were going to be in their early 20s making $150,000 a year. And this is over a decade ago. So I can't imagine what that is today. And maybe it's not that way. And I've probably made a lot of mechanics mad who aren't making $150,000. But that was a high level position, by the way, where you were going to oversee huge base of other mechanics. That was the potential there. Not that you would actually reach that, but if you had the certifications and you were just a regular mechanic there, $65,000-$70,000, 10 years ago, that was that's a really good income with having a minimal amount of schooling. And they had a program. I should even maybe I'll start to call some of these people, see if I can get them to come on the show, because I know I have a good friend of mine. He's HVAC guy, and he has a really tough time hiring people who have skills that want to work. That's a very common theme today, but it's always been that way for him in that industry. So my point to all this is that there are jobs. Is it easy? No, it's never been easy. This is America. I mean, you have the right to try. Not that they have to lay down and make it, roll out the red carpet for you. Sometimes you have to kind of really struggle. And I feel for you, believe me. I built my business cold calling. So I was a cold calling stockbroker when I first started out in this industry. And so the attrition rate was 19 out of 20 people that they hired wouldn't be there a year later. That's how daunting of a task that was. And I just didn't think I had another choice. I had to stick it out. But the bottom line is, if you want to do it, you can do it. You can find a way. There are lots of places that you can go, resources you can get. You can get a lot of help in a lot of different places. And one of the biggest helps today is Google. I mean, I can't believe how much you can find out on Google. Now, you have to verify, and it is time-consuming now. Now, any search that you do, you're going to get thousands of references to websites, and it is laborious going through all that and trying to talk to people there. But that's how it's done. Back in my day, we didn't have that. We had this thing. It was a manufacturer's directory, and I didn't even know about this until I started working for this company. So there was a manufacturer's directory. It was like a set of encyclopedias, and it had all these manufacturers, kind of like a little description of what they did and their business and their contact information. You had to pay a lot of money to get into that registry, and it was a Thompson, and it was fascinating. And I was just thinking to myself, when I took this class, and it was called the service was called Dialogue, and it was Google before Google, except that they didn't have Google. You had to sign up. You had to know exactly what the web addresses were, and then to type them in. And these guys were publishing a book that had all the websites of all these businesses. It was a book. And so it was just before Yahoo actually came out with the search engine. I think they might have been first. I don't know. I'm not really sure. But anyway, when Google came along, actually just the internet came along, I was going, oh, brother, this is going to mean major change. And it was. It changed the magazine industry, because there were a lot of magazines that were providing information on stuff like that. And that was a huge change. Now, a lot of those magazines still exist. A lot of them went to both digital and print. A lot of them just went completely digital. A lot of them went away. I hear the music. That means I have to go away for a few minutes. This is Bill Bullington right here on 1420. Stay tuned, because I'll be right back.
Does he see me in my trouble? Does he understand? Sometimes I question if he's able. Can he rescue? Can he save me again and again? But when I look back, did he move every mountain? years felt like 4 seasons of winter, and you'd give anything to feel the sun. Always reaching, always climbing, always second guessing the timing. But God has a plan, a purpose in this. You are his child, and don't you forget. He put that hunger in your heart. He put that fire in your soul. His love is the reason to keep on believing.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you have a question or you'd like to set up a phone meeting just to kind of get acquainted, you're welcome to come into the office. I will tell you that we're moving our offices just right across the street. It's literally, I could throw a softball that far. But we are moving, so you may not want to come in next week or the week after. But if you want to meet, there's no cost. I'll be glad to talk about your financial situation for you. We do specialize in asset management and retirement planning, retirement income planning. Actually, that's been my focus almost my entire career. And right after I talk about this part, I just want to let people know I'm going to use the last segment of each show to talk about individual stocks, because I've gotten a lot of people who got used to tuning in for that, and they really like that, and I like it too. It's interesting, it's fascinating. But so the first segment I generally talk about the economy and that kind of stuff. But again, our firm's focused on trying to help your money last as long as you do. I like to keep things extremely simple. I don't think you need to complicate this. It's complicated enough. Let's try to make it as simple as humanly possible. And there are certain basic fundamental ideas that you need to keep in mind when you're investing, when you're doing retirement planning, especially the retirement income planning, because it is rough today. The retirement income planning is extremely difficult. When I first started in the industry, I think CDs were paying around 10%. And that wasn't the highest, by the way. They had been actually higher than that before I started. So if you could get a 10% CD, I mean, really? You didn't really need to have a whole ton of dough to have a really good income, especially back in those days. Okay. So now that CDs are less than 1%, you need 10 times the money to get the same kind of income that you would have had back then. That's a challenge. That's a big challenge. The fact that stock prices, if you look at the top 50 stocks in the S&P 500, it makes up over half of the value of that fund, and a lot of them are overpriced. So you could say the whole index is overpriced, and it is. And that's one of the reasons that it's outperformed most of the other indexes around the world over the past 5 and 10 years, is because the overpriced stocks kept going higher and they kept getting more overpriced. That can be a problem. Now, it's not all bad. I mean, it could be rough. You could have a time period with inflation rising. If they start raising interest rates, I've always said I don't think they're going to raise interest. I don't think they'll raise interest rates a lot. In fact, they haven't raised interest rates, but rates have gone up. Why? Because the market's anticipating, and they're not waiting for the Fed, and they're selling the bonds now. When you sell bonds, prices if the sellers outweigh the number of buyers, the prices have a tendency to drop. When the bond price drops, the interest rate actually goes up, but that doesn't make you feel better when you see your principal is still down. When you're still losing money, it doesn't make you feel better. Well, hey, I had $100,000 and I was only getting 1%. Now I'm getting 2%. Why? Because the bond dropped by 50%. and that's basically what happens. Think about that for a second. You had $100,000 at 1%, and now the rates are 2%. You only need $50,000 to generate $1,000. Okay, so I'm not saying that the bonds are going to drop 50% on a 1% increase. That's very unusual, but it's just to illustrate a point. Bond prices drop when interest rates go up. The average portfolio is a 60-40 across the country, 40% fixed income, which works just like CDs, and they are bonds in most cases. So people have a huge chunk of money in this thing, and they've got all these exotic funds out there now that are supposed to be able to take care of it, and they won't. If it's a bond, it's a bond. It could be a junk bond, which means you don't have the guarantees of a government agency or a plus rated company behind it. That might pay a little bit more, but you're taking real risk to your principal, because if that company were able to pay back its interest easily, it wouldn't have to pay so much. Okay, so when you get a high interest rate, you have to immediately start going, how are they doing it? In most cases, you're going to be taking on risk that you may not even be familiar with, and that's the one thing it is hard. And see, the problem with this is most people are looking for this for safety, and the vast majority of people that are looking for safety are people who are older and they don't have the time to make up for mistakes. And that's why I think it's so important. And even BlackRock, the world's largest asset manager, has started to come out with annuities, annuities in their 401k plans. So annuities are a pretty good option given the environment that we're in right now, the environment that we're likely to stay in. And actually, it'll probably get better for annuities because it's going to get worse for bonds. And unless you're parking your money in cash and you're happy not making any returns, and money markets, I think, are paying about 1/10 of 1% or so. It would be better than losing money, incidentally. But if you're looking for some sort of a return in there, you got to look at a fixed indexed annuity. You just have to. I mean, it's the safest option. I mean, you don't have to. If you're in your 40s, forget it. Forget everything I just said. Just keep buying stock funds. And that's another thing that's really important for you to know. There's no one size fits all. There's no magic pill, magic formula. It just doesn't work. Life doesn't work that way. And if you're past the age of 50, you already know that. I mean, you've been around long enough to realize, yeah, if it sounds too good to be true, it is. And but with the fixed index, you've got rates that you can't really match in other asset categories. You've got a level of safety. You can look at the companies that you're dealing with, make sure they're at least A+ rated. Okay, that's a big deal. So they've been around a lot longer than most people have, by the way. A lot of the insurance companies, especially the bigger, more financially stable ones. And there's a big need for this, and so it fills that need. Now, when I'm looking at them, the only thing I'm worried about are the guarantees. I want to know what the guarantees are. I don't care about what it's invested in so much. You know what I'm saying? They give you options to invest in. I have there's an idea that I like that is available in that product. But basically, you're guaranteeing an income. That's what you're doing. You're trying to buy a guarantee on income. Now, again, it's only as good as the underlying insurance company that's making the guarantee. So you got to be careful. And I worked for one of the biggest and oldest insurance companies in the country at the time, and they ended up getting into financial trouble trying to make good on the interest rates that they had promised years and years before. When interest rates dropped, they still had to pay those high interest rates. It ended up straining their capital, and they ended up having to sell off to another insurance company. So what was interesting was when that happened, when that company basically folded, nobody lost any money because the companies that bought the assets made good on their promises. They cut the length of the guarantees on the products. They were allowed to do that. But they came back with a pretty competitive rate, and that's why that wasn't a big debacle and why most people don't even realize that ever happened. So, but not always. If you look back to 2008, 2009, if you want to avoid something like that, there's some pretty big insurance companies that were doing some things they shouldn't have done. They're highly regulated, by the way. The way they invest their money, they have to be conservative because that's their, people have claims against that. So the thing that they have going for them is that they're a corporation. They can ride out the ups and downs of the stock market. You and I can't because we have a life expectancy. And one day we're going to die. And the older you get, the fewer years you have to make back for the errors. So that's what you're doing. You're actually shifting your risk, and it's called longevity risk. And it should be called not enough longevity risk. Because if you die before it recovers, everybody you lose money or your family loses money. So, but anyway, that's what they call it, the longevity risk. And an insurance company, because they're still going to be around, they can wait it out. You know, they can be there and keep doing the things that they've done, at least try to. And again, I have to tell you, I'm paranoid with the whole compliance thing. You're not allowed to promise anything. The promises that are made by an insurance company are only as good as that insurance company is. So again, make sure you're staying with some very well-heeled companies. There's a AM Best rating. I like to see at least an A+. And the rates of return on those things are pretty significant, particularly when you're looking at everything else that's currently available. And I'm going to take a second right here. I'd like to pull this up. There's a website that you can go to. If you'd like to play around with it, you can put your age in there, and it will tell you how much money you could generate given a certain investment. And it'll also give you the opportunity to say, all right, I need this much money per year. How much do I need to invest to be able to do that? And I'll tell you what, my internet all week has been horrible, and it's horrible again today. This stuff is taking forever to come up on here. Normally that's not happening, and I don't know if you've noticed it or not, but I'm on the internet almost every day, all day. All of our stuff, we have, we're in the cloud, and the cloud, not the regular internet, not going on Yahoo or stuff like that, but we hook up directly into a lot of our custodians. And I'm telling you, it's slow. It's just really slow. And after all this time, and they've had all this time to work on it, I guess more people have. And that may be one of the bigger problems with the economy going forward. Not enough people to fill all the jobs that are available, especially once they start rebuilding the grid. I mean, the demand is outweighs the supply as far as the demand for services and the industry's ability to provide those services because they don't have the workers. And that has been killing me. I mean, it's unbelievably slow relative. I guess I was just spoiled before. I don't know. But anyway, so I'm looking at, they call it a guaranteed income tool. If you'd like a link, I can send you a link to this so that you can get in there and get around and play with it yourself. And I'm just going to try to pull one up here. Hopefully it comes to. And hey, look, it's starting to work. So this is a single person, and let's say you're 66. So next year you're going to qualify for full Social Security. Okay, 66 now. Next year you'll be 67. You're going to qualify for full Social Security. And okay, so I clicked on it, and it brought me back to the same page. Lovely. Oh, you're 66 years old. Next year you're going to be 67, and you want to know how much you can get out of the if you bought one of these. So here's the deal. You put $100,000 in, and you have to wait 12 months to be able to start to take income from it. Next year, the $100,000, they would guarantee an income of $5,956, okay, according to their website. $5,956 versus less than $1,000 in a CD. I don't know. I think it's worth considering. Anyway, I hear the music. I got to take a real quick commercial break. This is Bill Bullington. I'll be back after these messages.
And tell you all about my heartbreak. And I wonder to myself, wait a minute, am I even on the right path now? Had a couple wins, but I got knocked down. But I know that you are here right now, and you say, ooh, sometimes you lose, sometimes you win. Ooh, you gotta get up again. That can't be parted. There is no mountain that can't be moved. I know there's help for the heavy hearted. The weak will find their strength renewed. You just gotta have.
And we're back. Gotta have faith. Yep. And you know what? Oh, This makes people nervous when I say this, but our entire economy, your financial life, is all dependent on faith. It is all faith. And you know what? I think God's been good to this country. He inspired a lot of stuff. The first thing was the Federal Reserve. Because that is what has allowed us to grow as quickly as we can. The ability to extend credit, the ability to lend money and create it out of thin air. And a lot of people get really upset when I say that because they want to go back to the gold standard. Well, let me tell you something, dude. Because they're mostly dudes. Women happen to be a little smarter in this area. But as my personal opinion, I know that's biased, but just my own life experience. If you went back to a gold standard, you would have to, the whole world would come to a screeching halt. See, and at some point in time, you wouldn't be allowed to grow anymore because you would have mined every ounce of gold on the planet. Now, how do you pay for anything else when you've already got all the gold that there is? And I know that sounds to some people so ridiculously simple that it can't be true. And no, it is. But that's beyond the point. The Federal Reserve System, the banking system in this country, is one of the reasons that we're still the top economy. And we didn't invent it, but we recognized a good thing when we saw it, and we started putting it into place. Imagine this, the big screeching sound you'd be hearing all over the country is every industry, every business stopping if you had to pay cash for everything you got. Can you imagine paying cash for a house or a car or a refrigerator for that matter? You can do that, but and a lot of people do cash for their cars and stuff, but it would really slow things down. So that's what enables the whole thing, and it's the thing that's most important. It is most important. It drives the stock market. Right now, those interest rates are really low, and we've gotten ourselves into a situation where we've got a ton of debt. So if you raise the interest rates, the government has to raise the interest rates on all those bonds, and they're going to have to pay that. And I'm not sure that that's the smartest thing to do, to raise the government's payments, obligated payments, by billions and billions and billions of dollars, especially right now. So, and it's always been tough. It's never been easy, but I think we've done a really good job of it. And there's some other countries that haven't done quite as good a job of it. But again, a lot of it comes down to having faith in the system. If you have faith in the system, then you're going to relax. By the way, the way to have faith in the system, and the next time I do a seminar, whenever that's going to be, whenever it opens up and we can, sit closer than 6 feet apart, I guess, because I'd probably be able to fit about 20. That's about it into a space. But we'll talk about this in more detail. It is the most important thing, and it's the reason that the United States, one of the main reasons that we've done so well as an economy. It's the ability to extend credit. There are a lot of other reasons, but that's a major contributing factor. By the way, we didn't invent this. It was invented in Germany, who exported it to England a couple hundred years ago. Actually, might even be a little bit longer than that. I think it is. And then they exported it here. We caught on to the idea really quickly. And it's what caused the country to be able to expand as fast as it has. And it's the most important factor in the economy. How are the banks doing? Are they lending? Are they raising? By the way, raising interest rates will not stop people from borrowing money. I don't know if you've ever talked to many people who borrow money, buy cars they probably shouldn't own, buy houses they probably shouldn't live in because it's not in their budget. That doesn't stop them. So as long as you'll lend people the money, there's a huge portion of the population that will take it. You lend me the money? Oh, great. And so if it's not available, then that's when things slow down really quickly. Raising the interest rates will cause some people not to qualify for a loan that they may have qualified otherwise, depending, it's based on their income. So that has a slowing effect. But if you really want to slow the economy down, raise the reserve requirements on all the banks. That screeching sound you hear is the market crashing. It will recover, by the way, because once they do that, they have a tendency to go back and unwind it and start it all over again. So it used to be called an economic cycle. Now the cycles have little tiny mini cycles going on. It's just that part's really mind-boggling. So I'm going to leave all that stuff, the deeper stuff, and we're going to we're going to talk about stocks for a few minutes, because I know people have they like that, and I like it. It's something I haven't been able to do nearly as much of. And yes, I am still holding on to purple, and yes, I'm getting my butt kicked. But I still like it. If these guys talk about bad luck, holy cow, they broke ground on a factory. The mattresses, by the way, are awesome. I recommend them highly. I've had one forever. That's why I bought the stock. Well, one of the reasons I bought the stock. The financials are pretty good, particularly since they started to build their own factory right at the beginning of the pandemic and haven't been able to do that. The sales are very strong. The gross profit margins are extremely strong. They're just a young company, and they had they've got a lot of debt to be able to try to expand. They were going to try to expand quickly and put a factory in the United States. They had to have these things made in China and shipped over here. And I'm going to tell you, those are heavy, because I had to move it. They are really heavy. It's got the whole mattress, the box spring, everything's built into one unit. And by the way, they rolled it up in a ball, or in a roll, and I had to unroll it. I was amazed that they were able to do that too. So technology is pretty interesting. But the bottom line is, I hope these guys make it. I do own the stock. The symbol is PRPL. And it made a new 52-week low yesterday. It's not the all-time low, when it hasn't even been public that long. And but anyway, I still like it. It's under the price that they came public at, and the company is significantly larger than it was then. And there's just a lot of stuff going on, but I'll leave that one alone. And just when I go through, typically what I'm looking for are one of two things. I'm looking for a pattern that occurs in stocks that are going up really fast. There are actually several patterns that occur in those. And I'm kind of glancing and looking through that. And once we're able to do meetings again, once I get in my new office, they have an auditorium in that building that I can use, and we can do little mini seminars. And I have an investment club I know that would really love to be able to use those facilities. It's just so much easier. And then it's a lot easier to talk or to show you what I'm talking about, rather than just trying to explain it, especially on the radio. But I'm just going through, and I'm seeing there are a lot of stocks on this list, by the way. That's one of the things that tells you how weak or strong the market is. When you've got more than 100 stocks that comes up on this particular scan, it's pretty strong. Right now, there are 132, and it's only 10:20 in the morning. So what that tells me is the market has started off really strong for the day, because that's a high number of stocks to come up there. Now, by the end of the day, it could be down to 5, because the market could start to sell off, the stock prices start to drop again. This is all based on price movement. And I like to kind of try to combine price movement with what I think the company might be worth. And that helps a lot. Like here's I'm going to take a look at this one when I get back to the office. It's United Fire and Casualty, so it's an insurance company. The symbol is UFCS. It was $37. This is back in 2021. Let me go through. Yeah, the high was over $60 in 2018. So it was over $60. It's now down to $28.90. Had a huge day 3 days ago. It was up a lot on a huge amount of volume. That's what you want to see if you're looking to kind of ride the wave. It's a momentum style of investing. It's not like purple I buy because I like the company and I think the financials look really strong. And I think at some point in time, it's probably going to, if it survives, it will probably sell back up around $40 where it was before it started crashing. And I've added to my holdings, by the way. I did one of the things that you're not supposed to do if you're a trader. I bought on the way down. And so my positions, I've got a lot more shares than I had before, and they're a lot less expensive now. But anyway, that is the total antithesis of what I'm talking about now. What I'm talking about now is, and this is basically long-term trading. You're looking for clues to find those stocks that are going up really fast right now, who you think may have a chance to continue. And if they don't continue, you're just going to get right back out. And so we'll talk about that again. And again, I can't wait to get into the new space, because hearing it is one thing. Seeing it is another. And once you point it out, everybody's like, oh, that's what that is. Yeah, that's what it is. And it's not magic, by the way. Actually, it takes a lot of patience, and rightly so. I mean, if it were easy, nobody would ever have to work. So anyway, that company, United Fire and Casualty, why do I like it? Well, according to Telechart, now I will double check this with my other sources, but the price to sales ratio is 0.53, and the average for an insurance company is over 1. The price to sales ratio is typically 1 or higher. Some I've seen them get as high as 2, which is a lot for an insurance company. But this one's 0.53, and it comes up on a momentum scan. So I'm going, oh, that's interesting. I'm going to check that one off, and I'll go back and look into their financial statements, find out, first of all, why did it drop so low? Secondly, what's going on now? If the company's recovering and their profit margins are starting to expand and their revenues may be expanding a little bit, hey, we might have something there. So that's one of those things that, I'll talk about it from now on. I'll take some time to talk about this on each and every show. And because it's fun. It's actually, if you're doing it for anything more than a hobby, though, I think you might be making a mistake. I think just a hobby, because there are funds that are using criteria that's extremely similar to what I'm using in my scan. And if you don't have time, or don't want to put the time in, or you just don't have the patience, the funds are the best way to go. I have a ton of my money invested in those funds. Yeah. But I like to do this too. And I like the investing part of it. I can't remember how long I've had Discover now, but it's been a long time. And I got Discover. It came up on the momentum scan, and I looked at it and go, oh, there are only like 3 really big credit card companies: Visa, MasterCard, Discover. Actually, 4, there's the American Express. And they're all extremely profitable. And, everybody's thinking that they're going to push Discover out of business. The bigger ones, we're going to push them out of business. I'm like, yeah, well, that might happen, but I don't think so. So, invested in it and did pretty well. Then it got crushed when the market dropped in March of 2019. I go from, I think I bought it in the somewhere in the mid 60s, and it was in the mid 90s. And then a couple weeks later, it's 26. Think about that for a second. From mid 90s to 26. So I bought some more in there. I think I got my average cost basis down around 32 or something like that, and I'm still holding it. And let's see where that is now today. It's 123. And it's been all over the map. I mean, it's been crazy. In fact, I was talking to this guy who was trying to recruit me away. By the way, I'm never going outside of my own firm. But anyway, he was trying to recruit me, and I know he knew what he was doing. He was extremely knowledgeable in stock markets. And he knew that I owned Discover, and we had talked about it. And when we had talked about it, it was actually in the low 30s, and it got all the way down to, I think, $24-25, somewhere in that neighborhood. I just added a couple times because I really like that company. And I never put so much in one company that it's going to jeopardize my financial health. I just don't. That's not my personality. And by nature, I'm actually pretty conservative. And I know it doesn't sound like that on this show a lot. It sounds like I'm extremely aggressive. I'm really not. I actually have the nationwide product, and I'm not going to be retired for at least another 12 years. I'm going to try to. I don't know if I'll last as long as Warren Buffett. Guy's 90 and still doing it, every day. That blows my mind. I mean, that's amazing. So I don't know if I'll have that longevity in me, but I'm going to give it a shot. And it is fun, and it's nice. you can read about this stuff. It's so leisurely anymore. It used to be you had to scramble to try to get access to the information, or your downloads were really, really slow. All that stuff has changed. And it's just amazing how much stuff is out there. And that's one of the problems, though, is that there is a lot of stuff out there. And you have to kind of figure out what your favorite sources of information are. I use Morningstar. But anyway, I hear the music, and that means my show is over. If you heard anything you have questions on, please feel free to email me or call us. My contact information is on my website, bullingtoncapital.com. My name is Bill Bullington. I'm here every Saturday morning from 11 noon. Have a good week, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.